Hello, in this video I'm going to cover what we call the $1,000 deductible self-insured option. This option is a section where if someone has full coverage on their vehicles, they have different options. One of the options is they can have a zero deductible. They can have $100, $200, $250, $300, $500, $1,000. They can have a lot more than that, but you need to find out what they have. In the new system, if it's not live yet, when you see this, it will be shortly. There's a place for a secondary form where they can actually give you the information on what deductible they have. When they do, that data will come in right in here for you automatically. So you won't have to ask when you're in this stage, but you'll be able to get that ahead of time. So I'm going to just put down that there's a $100 deductible on both of this. In our research, we found that $1,000 deductible, raising your deductible to $1,000 is the most efficient and premium decreasing amount you can get. Now you can go to $2,000, $2,500, $3,000 deductible. They don't give you much of a break. But once you get to $1,000, that optimizes the amount that the insurance company will lower your monthly premium. What we found, typically it was between $34 and $58 a month on average per vehicle. Now obviously there are more expensive cars that can be higher than that. There are less expensive cars that can be lower than that. But here's what we found. So I'm going to use those two things as the criteria in this demonstration. So we've already run the illustration without this in it, and so I'm going to cover those numbers first. So right now there's 84 payments are saved and $67,074 in interest saved. So 84 payments and $67,000. So that's our starting point. So now I'm going to go to the $1,000 deductible self-insured option. And what happens here is, well, you're going to have them get back with their insurance agent and find out what the cost would be, what the difference would be if they were to go to $1,000 deductible on each vehicle. And so in this case, I'm going to say that they save $42 on that vehicle. And let's start it in a year from now. If they're making annual premium payments, then when they do cross into year 2, there will be enough, because what we have to do is make sure that, because we're becoming self-insured, what happens is you're not going to start this until after there's $1,000 or $2,000 in the account to make sure that they're covered for the deductible should they need it. So this isn't going to start immediately. It'll start in 1 to 2 years, and so we will put that in play. So we're going to start this in March of 21. We're only going to do this for 5 years, and so the system will calculate that it'll finish in 03 of 26. The next car was a little more expensive, and so let's say it was $57, and we're going to start that in March of 21 as well. We're only going to run that for 2 years, and so it calculates 323. So that's all we need for this when you're done. Now let's go ahead and rerun that calculation. Okay, so we were at 84 payments saved before. Now we're at 88, just by taking, again, this is money that they were already spending, and now we're going to utilize it to help pay down their mortgage. We just saved them 4 months of payments at $1,711. So let's look at the calculator and show you what that value is. Okay, so we had 4 months at $1,711. So that saved them $6,844 in mortgage payments, and it cost them nothing extra. This is what they were paying anyway. Just happened they were paying to somebody else. Now they take it and redirect it and put that in here and utilize it to help accelerate their mortgage. 4 months, $6,844. So as we look at the table, we see $1,711 in March of 2021. We add the $42 that now we're going to redirect $42 that was going to an automobile insurance premium to coming back into the mortgage, and the same thing for the $57. So you see both of those amounts are started right here. We add those together, it's $99. You add that to $1,711, it comes to $1,810. So that increases it. It only runs for 2 years, and so the $57 terminates, and then the other one runs for 5 years, and the $42 then is subtracted out, and we're back down to $1,711. So that's the part where it shows that it starts and it ends. Now we're going to go down to the other section for the policy. In here, normally we would pull out all $14,937, but because they're self-insured, we only pull out $12,290 that's available. So we actually are going to leave a couple $1,000 if that's what's in the circuit. We're going to leave that in the policy so that they can be self-insured. Again, you don't want to start this until there's enough money to cover that. Here there's $3,852. So when that amount is in the cash values, then we know their $2,000 deductible is covered. So that's all you need to know, but it can be very impacting. It can change the flow of this. And when you start adding all these together, the additional, you do the PMI, the the self-insured part for the deductible for vehicles, adding in just a few dollars that rounds it up to $25, $50, $75, or $100, and then anything else that you do that adds in out of this, it all just amplifies together as you do this, and so you can see how much more powerful. So I just showed you these one at a time, but the system will track all of those when you put them all in at one time, and you can see what the results are.